Welcome to the daily update, where I'll go over the action in the market for Friday, August 25th, and then we'll see how things are looking for Monday, August 28th. Everybody anticipated the big speech by Chairman Powell. Nothing really new was said during that speech. Nothing that was all that surprising. It was more about what he didn't say. He didn't talk about cutting rates in the future. They tried to spin it as more negative right off the bat, but then later in the day, the market recovered and we ended up having an up day. Please be aware that I will be doing a free online course. The 3-hour session will be on Monday, September 4th. That'll be Labor Day. If you're able to make it at that time, I will record this. And then the following week, I'll be doing 1-hour sessions for 3 days, Monday, Tuesday, Wednesday, on September 11th through the 13th. I do plan on streaming on both YouTube and Rumble at the same time. I'll also be using Zoom as a backup if things don't work out all that well. Let's go back and talk about what happened. Right at the open, we had a higher open, but it was below the daily pivot at 44.03. Prices were pretty choppy as the speech was unfolding, and then we chopped down below the unchanged level to go negative. Then we chopped back higher to get back above the unchanged level, and we got to the daily pivot, and when we closed slightly above the daily pivot. We didn't hit an R level to the upside or an S level to the downside during Friday's session. We were up 0.67% on below average volume. That still continues. The technicals are still negative overall, but we were looking more positive after Wednesday. That was when we had an up day. Then Thursday, we had a down day, so things were switching back more negative. Well, after Friday's session, we're now looking more towards the improvement side of things. So it just depends right now because the market's kind of at a pivotal point. It's about inflation, interest rates, and growth concerns going forward from here, and then any Fed speak that we may get. The comments that we can make during Chair Powell's speech didn't really say anything new, nothing that was surprising. But he didn't talk about cutting rates, and they tried to spin that as being more negative. The scenario that we're currently working on is what we've been developing for a while now, and it tends to be more pessimistic, where the economy is stronger than expected. That's a good thing. And that the Fed will need to keep rates higher for longer. They see that as a bad thing. And then possibly raise rates. That's also kind of a negative thing. And then we're a bit concerned about the economy in China because they're having to stimulate things after a lot of weaker than expected economic reports came out. The 50-period simple moving average is providing overhead resistance, not only for the S&P, but for pretty much all the indexes except for the small caps. So we're going to need to see uniformity closes above the 50-period simple moving averages on all the different indexes for things to turn even more positive. As long as we stay below that resistance level, we're more neutral to even negative. We don't have any short-term indicators right now that are giving us oversold readings. Those have all been worked off. In the intermediate term, we have the PMO studies, and I have a chart to show you that. The dollar was up and interest rates were also up. Typically, both of these together would provide headwinds for stocks, but didn't seem to matter as much on Friday. And the dollar's been quite strong lately, and I have a chart to show you. The yield curves that we follow are still inverted. Sentiment is neutral at 48, where it had been at 49. Our trend, we're negative in the intermediate term. The ADX is still below the moving average. The red line is still on top. We're declining, so it's a weakening trend, but we're still above 20 overall. Our bias is positive, and our momentum I've changed over to mixed. It's all going to come into play about this 50-period moving average, not only for the S&P, but for all the other indexes. The economic reports that came out, well, we had the speech, and then we had consumer sentiment. The final reading was at 69.5. They had expected 71.2, so a little bit weaker than expected. When you go back a year ago, we were at 58.2. So sentiment is getting a little bit more positive. Here's the chart. The blue line is showing how people are feeling about things, where we have been seeing some overall improvement, even though it ticked down in the latest reading. We also plot the 2-year yield on here, and typically they have a tendency to go in the same direction. but there's still a really wide spread between the two right now. So, but we've been watching this for quite a while, and that's what I measure down here below. Then just a couple of charts from isabelnet.com on their blog. Most people now are suggesting that we're not going to go into a recession in the next 18 months. That's 31%. We're seeing a real shift in that, where there's other people that think that, yes, we will go into a recession at some point. Some of the charts that we look at do suggest that we're heading into a recession, but then other charts that are kind of the official charts that we look at, they're still hanging in there. So we just kind of have to wait and see how this plays out. We did get the latest reading from the active asset managers where they had gone extreme positive above 100. Well, now in the last two readings that we've been seeing, we've really dropped. We're not quite in an extreme negative reading yet, but not quite as positive as they were. And I go over this again in the weekly video. We're also keeping an eye on this. This is an average of the VIX from 1990 up to 2022. That's the blue line, and that's just an average. And then the red line is the VIX and what it's been doing lately. And I'm not a big fan of these because a lot of people make their decisions based on this. I don't do it that way. But this can be a good guide because you can see where for a lot of this year, the red line has been following kind of close to the blue line. If we do end up following what's been happening on an average basis, the VIX is really going to go up, which means stocks would be going down. And we'll just have to see how that plays out. Here's the intraday chart where we did gap higher. We came up almost to the daily pivot here. And then we were really choppy because this is while Chairperson Powell was speaking. We ended up chopping lower below the unchanged level. Then we found some buying coming back in, but you can see these bars are pretty wide. That just means there was a lot of buying and selling going on. We eventually made it back above the daily pivot and then closed just a little bit above the daily pivot as well. Here's the intraday chart. The initial overnight session did see a bit of a bounce after we had a really strong down day on Thursday. And then that carried over into the pre-market session. And then we had the speech with all the choppiness going on. But then we ended up finishing fairly strong and then trailing off as the market closes for the weekend in the initial overnight session. Growth versus value, we still are seeing the blue line on top of the red line, even though they're on different scales, where growth continues to outperform value. This is the chart that I was watching. We did see a spike up right after the open, which suggested, okay, we might get some kind of a bounce here. But then after that was done, we pretty much chopped sideways, but then saw a little bit of improvement going into the close. So overall, growth did outperform value, but there wasn't a lot of conviction behind it. The VIX was declining on the line chart because we had the up day. We also closed near the low of the bar on the bar chart, showing that fear is decreasing a little bit. And we're not above 20 yet. Even though the VIX had been really going up, we're still below what historically is a high level. Also looking at the VIX of the VIX, showing how volatility is really decreasing. Then we look at the equity put call ratio and take a 5-period simple moving average. We're starting to turn back up now. We had been declining after we spiked up. If we continue to decline, that would be positive. But the fact that we're inching back up, that's turning things a little bit more negative. Longer term, the VIX to the VVIX ratio is also turning back up after it had been declining. That's more negative. The longer term equity put call ratio also was declining. That's positive, but now starting to turn back up. That's still more negative. Looking at the condition of our trend, we have the ADX below the moving average. It is declining, but it's still above 20, just barely. The red line is continuing to be on top, so we would default to the negative trend. The shorter term, we're below 20, suggesting we're in a trendless environment. We're just a little bit below the moving average, and the red line is still on top, so we would default more to a trendless environment, but if anything, it would be to a negative side, even though we would base things on being trendless. Here's the daily chart where it looked like we came down to this previous low, which was also a previous high. We tried to bounce up off of that. We hit the 50-period moving average, which is just about at this pivot level, and this is providing overhead resistance. We came down on Thursday and then bounced a little bit back up on Friday, but nothing to really improve things all that much. We can see where volume continues to trail off and is below average. The stochastics in the short term are showing some improvement, but they're still negative. In the intermediate term, also some improvement, but negative. And we're no longer extreme negative in the long term and also showing some improvement. Please be aware that when I say short, intermediate, and long term, this is a further subdivision of the short-term time frame. So we have short-term, intermediate short-term, and long short-term. Looking at the Swenlin trading oscillator, are seeing some improvement, but we're still below zero based on price and volume. We're coming back up into the -1 standard deviation now. We didn't get back up to the midpoint. To have things turn more positive on this chart, we want to close above the midpoint and then eventually see these purple waves start to turn back up, and we're not seeing that yet. The summation index based on price has now dropped below zero and it's continuing to decline, where before that we already dropped below zero based on volume, so this chart is still negative. The NYSE bullish percent index dropped below 50 and it's continuing to decline. That's on a broader measure is more negative. The mass index, we're watching this to see if it's going to generate a signal. We're coming above the red dash line. We'll wait to see, do we cross above the blue line? And then when we turn back down and cross below the red dash line again, that would be a signal suggesting a trend reversal. We're also keeping an eye on our different fib levels. We're still above this 100% retracement point on our short-term fib chart. If we start to drop, we'll be wondering if this is going to provide support. A longer-term fib chart, we're still above the 61.8% retracement level. If we start to fall, will that provide support? Accumulation distribution, this is still negative. It's improving a little bit where it turned up, but we're still below a declining moving average. And this tries to measure what is the smart money doing. If you notice back in late July into August, this gave us a heads up before we started to head into the problems that we've been seeing in August. So for this to turn more positive, we want to go back above the moving average and then stay there. However, the parabolic SAR continues to be positive with the dots underneath the price bars. The slope oscillator, this is our shortest term and touchiest oscillator that we look at. We're trying to turn back up. We're just barely above the moving average. So this is improving, and we're also coming off of an extreme negative reading. So this potentially could be positive. Looking at our moving averages, where it's the 50-period simple moving average for the S&P that is providing overhead resistance. We spiked up to that level on Thursday, dropped back down. We came back up to close just a little bit below the exponential moving average based on 50 periods. So we want to get through that first and then eventually the simple moving average. We're also a little bit concerned because we're seeing the 20-period moving averages continuing to come down, and they might provide overhead resistance. Seeing a little bit of improvement with the Chaikin money flow. The moving average, which is the red line, is continuing to advance, but we're still negative. The PMO study, we're no longer extreme negative with the PMOs that are rising, and these are improving. Where we're extreme negative is in the buy signals, and we're just barely trying to go flat to turn up here, where we're still declining with the PMOs that are above zero. The weekly chart of the PPO studies showing a little bit of weakness in the long-term, intermediate term. We're still below zero in the short term, but we are seeing some improvement. We're still inside the Ichimoku cloud, wondering if this is going to provide longer-term support. When we compare growth to value and take a ratio of that, we saw a little bit of a tick up. Earlier on, we were coming back up, but we were not able to break out above this previous high in this ratio. We want to see this continue to go up if we're going to turn more positive. However, in the short to intermediate term, we've actually been going sideways to down, but in the longer term, we're still in an uptrend with this ratio. Keeping an eye on Dow theory, we're just about back to the breakout point with the Dow. So far, the transports have been able to stay above where they broke out to the upside. Saw a little bit of a tick up with the utilities, but they continue to lag behind. The Dow was able to get back above this pivot point. That's more positive, but it's right in between the 50 and 200-day moving averages. So for this to turn more positive, we want to see a close above the 50-period moving average. We're also seeing overhead resistance with the NASDAQ 100 coming back up to the 50-period moving average, which is also at this previous high where we've been having a hard time breaking out. We did that before, only to come back down and fall below this. The longer we stay below this, the more this becomes overhead resistance. Then on a trending basis, we're still negative with the NASDAQ 100, where the PPO is flattening out, but it hasn't crossed back above its moving average, at least yet. This would be quite a positive sign if we could turn back up with this indicator. Keeping an eye on the NASDAQ 100 fib levels, we're still above the 61.8% retracement level. If we fall, we'll be watching this level. As long as we're above it, that tends to be more positive. Keeping an eye on the NASDAQ, also dealing with its 50-period moving average. We did see an improvement on Friday, but not enough to close us above the 50-period moving average. Keeping an eye on the fib levels for the NASDAQ, we're right in between. We're above the 50% retracement, but still below the 61.8% retracement. We want to get above this and then close above this for things to turn more positive. If we turn more negative, we're likely to see a break below the 50% retracement level. We still have not been able to break out above the 50-period moving average based on the FANG index. The small caps are just a little bit below their 200-day moving average. We were able to recapture that on Wednesday. We lost it on Thursday. We're just about at that moving average after Friday. It would be more positive if we could get back up to the 50-period moving average. That's the negative side. We're not there yet. On the positive side, we did have a recent golden cross that was generated. Here's the Russell 2000 small cap index showing a little bit of improvement with the RSI. We're still above the 200-day moving average on this chart, but the MACD is still heading lower. The mid caps are right in between the 50 and 200-day moving averages. We want to see this go back above this pivot level and then eventually get back above the 50-period moving average to turn more positive. We did have a golden cross that was generated back in June, so the overall longer-term trend continues to be positive. Here's the dollar. We're getting up into the 104 range. We saw some weakness where we dropped below 100, and we've been marching back ever since then. At some point, this might give some headwinds to stocks. Back in 2022, as the dollar was going higher, it was going higher as stocks were going down, which is why we keep an eye on this. We're still in a longer-term downtrend where the moving average is, the 50 period is below the 200. But on the weekly chart, we're just getting ready to cross over positive with the longer-term trend. Looking at bond yields, we were up slightly with the 10-year bond yield, but it was virtually unchanged. Interest rates have been really going up lately. We're also seeing a bit of a tick up with our 3-month yield. When we look all the way back to 2007, this is where we topped out, and this is right before we had the great financial crisis. What we're watching for here is a top out in the 3-month yield, and then when it starts to come back down, is that going to be on the heels of some kind of economic news that throws us into a difficult situation? That's why we're keeping an eye on the bank sector and the financial sector. According to Tom Bowley's research, we're coming into the latter part of August where we tend to see overall weakness based on his research. So what is our outlook for Monday? We're still dealing with earnings reports as they're coming out. The technicals are negative, and we're back to improving. We were improving after Wednesday, then looking weaker after Thursday. Now we're looking a little bit more positive. We won't have any economic reports that'll come out on Monday. We're keeping an eye on the geopolitical events. But for the market, it's about inflation, interest rates, and growth concerns. Here's the new calendar for the upcoming week. We will get the second estimate of GDP on Wednesday, which if it comes in the same as the first estimate, that won't be a real big market mover. If there's a big shift, either positive or negative, that could impact the market. The big one is going to be the personal income and spending, as well as PCE prices on Thursday. That's the other big inflation gauge that the Fed really fixates on. And then the big economic report will be the employment situation report on Friday. at the same time, we're going to get the ISM manufacturing index. So later in the week, we have some pretty influential reports coming out. Looking at the Stock Traders Almanac statistics for Monday, August 28th, we're neutral to negative with the Dow, where we're neutral to positive with the S&P and NASDAQ. And then we're not really seeing this nice little bounce, at least yet, that we usually get during a presidential election cycle. We were supposed to get that, but the market's been chopping sideways with more of a negative slant. We're seeing that same thing with the NASDAQ. We're not seeing what historically has been a nice bounce going into the end of August. It just really hasn't happened yet. And then looking at the S&P during a pre-election year, the green line, that's a pre-election after a midterm bear, which is what we experienced. We sometimes see a nice little bounce going into the end of August. It hasn't materialized, at least yet. We will be on the 20th trading day of the month. And then looking at this next chart during a pre-election year, we follow the green dash line, where we do tend to be more positive than negative. Where the other stock trader almanac statistics that I show you, that takes all the years together. This goes back to 1950 and only looks at pre-election years. So what about our scenarios? We're still leaning more towards the downside because our charts are still negative overall, but we are showing some improvement after the upward move that we saw on Friday. It's going to be about the 50-period moving average, and not only with the S&P, but the NASDAQ and the NASDAQ 100 as well. It would be nice if the Dow and the mid caps and the small caps would participate, but we're really focusing more on the NASDAQ and NASDAQ 100. We're not going with the up scenario right now because we're still looking negative overall. In the short term, you could still look at doing some sideways type of things if you implement those strategies, because on a short-term basis, the red line is still on top, so we would default to negative, but we're below 20 and still not quite crossing above the moving average yet for our ADX indicator. So our warning signs, we're wondering this convergence of these short-term bearish signals, which you could almost turn to intermediate term now, because we started to deal with these at the end of July, going into the first part of August. Are they finished yet? Probably not until we close above the 50-period moving average. The longer-term trend signals, I didn't show the charts this time. We're still below both those trend lines. And those trend lines, well, on the NASDAQ 100, they go back to 2009. But the trend line for the S&P goes all the way back to the 1987 crash. So the fact that we're below that could signal a more short to intermediate term to even long term. It depends on how we get going with things, that we might be at a top. We're in a seasonally and historically weak month, and August is pretty much playing that out right now. We're supposed to have a little bounce in August that just hasn't happened yet. The S&P 500 oscillators are negative, as well as the NASDAQ 100 oscillator that we've been watching. They're showing some improvement, but they're not turning positive yet. The VIX is still climbing, but it did decline on Friday with the up day. The equity put call ratio is spiking and coming down, but it's starting to turn back up. So we're a little concerned about that. We're still below the 50-period moving averages with all of the indexes that we look at. The cumulative new highs, new lows for the NASDAQ are still showing weakness. We're still above the 3-month yield where we were back in 2007. That's before the great financial crisis happened. That's why we keep watching this chart to see if it really starts to turn down. Is that giving us a warning sign? And then we're still dealing with earnings season, but it is slowing down a bit. In the background, we still have seasonal and setups that are positive that are in the background that I will go through in the weekly video. The daily special K chart is positive. The weekly chart is negative. The longer term equity put call ratio, it's been declining, which is positive, but now it's starting to turn back up, which is more negative. The S&P remains above the downtrend channel upper line. We're still in a longer term risk on posture, but shorter term, we're in a risk off posture. The S&P is outperforming utilities, and the staples to S&P 500 ratio is declining. Both of these are supposed to give some support to stocks, but it just hasn't really happened. The Russell, the small caps, and the mid caps did generate recent golden crosses. Small and mid cap growth is still positive, even though it's been chopping sideways. The financial sector been getting creamed quite a bit lately, but it did generate a recent golden cross. The parabolic SAR daily chart continues to be positive. So our conclusion, we are negative but improving in the overall picture. In the short term, we're negative improving, as well as the intermediate term. We're still positive in the long term. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post over the weekend. I do hope that you have a great weekend, and I will talk to you in the next video.